Hello and welcome back to another video lecture series for financial accounting. In this video, or this week actually, we're going to cover two chapters. Chapter 12, which is a statement of cash flow, and then we're going to get into chapter 13, which looks at analysis. How do we analyze financial statements? So this chapter really deals with the last of the financial statements. So if you think back to the beginning of the course, we did our journal entries, we did our adjusting entries, and then we said, okay, after that adjusting point, we can go ahead and prepare our financial statements, right? And we saw how to prepare the income statement. That's the first financial statement that we need to prepare. That gives us the net income. And then after that, we prepare the statement of owner's equity, which we use that net income to increase our statement of owner's equity. Remember that net income actually increases those the retained earnings. Once we have our statement of owner's equity completed, we can then go ahead and do the balance sheet, right? And the balance sheet just lists all the assets, the revenues, the owner's equity. And then once we complete that balance sheet, we can go ahead and do a statement of cash flows. Now, the statement of cash flows is actually, it's kind of fun to put together, okay? Because there's a little bit involved in analyzing the balance sheet, categorizing what each item is as far as how does it fit within the organization's major activities. And if you remember, we way back when, 6 weeks ago, we said that all companies do three things, right? They all operate, they all have operations, they all invest, and they all finance. So what we're going to do then is we're going to take those balance sheet items and say, okay, which one of these falls under each of these three categories? So as we go through this video, we're going to look at the content of the statement of cash flow, and we're also going to look at the format. How do we format the statement of cash flow? So the first thing we need to recognize here is that what we're really trying to do when we prepare the statement of cash flow is we're basically trying to prove our cash balance, right? So remember that the balance sheet is like a Polaroid picture, right? It shows us the values of those accounts at a particular point in time. So when we do the statement of cash flow, we're looking to basically prove where did our cash go or where did our cash come from based on those three major activities, okay? So the first thing we need to realize that what is cash and cash equivalents, right? Well, we know what cash is. Cash is money, right? The dollar bills, the change. Cash equivalents are a little different, right? We consider them cash because they are something that is very, very liquid, right? Things like CDs, maybe U.S. Treasury bills, money market funds. So they're very liquid. We can, with almost certainty, determine what their value will be when they mature, okay? So in other words, there's really not much risk associated with those short-term investments that we have, okay? So when we're looking at the statement of cash flows, remember, this really complements the balance sheet, right? Why? Because it shows us detail on how the cash changed. And when I say cash, I mean cash and cash equivalents between the two dates, right? Here's the beginning balance of cash and cash equivalents. Here's the ending date, or here's the ending balance of cash and cash equivalents. So what that statement of cash flow does is it allows us to see what is that change? Where did that change come from? Okay. So in your study guide, I ask one of the questions says, hey, what are cash equivalents, right? Well, cash equivalents, again, just to kind of reiterate and make sure you get it in your study guide, is that those cash equivalents are those short-term very highly liquid investments, right? These are very easily converted to cash. They're extremely close to maturity, and we can determine what that or what that value is going to be when it matures, right? So we already listed a few examples: CDs, UST bills, money market funds, or even commercial paper. Okay, so when we're looking at the statement of cash flow, it's set up to basically, like I said, detail that change in cash. So we have three activities, right? Those three activities are our major business activities. All companies have an operations, right? They all have operating activities. So that means they get cash in or inflows from providing a service, selling goods. And then there's also cash outflows that are associated with operating activities, right? That is the money that is spent on our operating expenses, all of our supplies expense, utilities expense, wages and salaries expense, things like that. Okay. Then we have investing activities. So when we're looking at investing activities, we're looking at cash that is received from us selling something. Now, that's not to say that we're selling our merchandise. We're selling things that are revenue producing assets. So things like property, plant, and equipment, any intangible assets, any investments that we hold. Okay, those are all examples of cash investing activities, cash inflows. Then we have cash outflows that are associated with investing activities. Well, anytime we spend money to buy property, plant, equipment, anytime we spend cash to purchase investments, anytime we use cash to maybe purchase some intangible assets, those are all examples of investing activity cash outflows. Then we have financing activities, okay? Now, financing activities revolve solely around our stocks or our bonds, okay? What do you mean by that? Well, what I mean by that is, let's say we issue more stock, or we sell stock, or we issue debt and we sell bonds. There are bonds that are associated with our organization. Those are financing activities, okay? Anytime we retire debt, we buy back securities, we pay a dividend. Those are all examples of financing activity cash outflows. Okay. Now, I've noticed over the years that students get a little confused on, well, I'm buying and selling stocks, so that should be investing. Well, we need to ask ourselves, whose stocks and bonds are we buying and selling? Are we buying other companies' securities in stocks and bonds? That's an investing activity. If they're stocks and bonds that are based on our company, it's a financing activity. So as we go through each of these activities, what we do is we net out the cash flow, meaning look at operating activities. We take all the cash that comes in based on operating activities. We subtract out all the cash outflows based on operating activities. We end up with cash flow from operations. We do the same thing for investing activities. We say, okay, here's all the cash we received from investing activities minus all the cash that we spent on investing activities. We net those two out. We get cash flow from investing. We do the same thing with the financing activities. Hey, did we receive any cash from the sale of our debt or our equity? We subtract that from any cash that we paid to retire our debt, buy back our securities, or pay dividends, right? That's cash flow from financing. So we need to remember that cash or changes in cash are not accounted for on the balance or on the statement of cash flow, meaning you will never see a line item that says our cash changed. That's what the statement of cash flow does. The entire statement shows here's your beginning cash balance. Here's all the money that came in from operations. Here's all the money that came in, or let me rephrase that. Here's the net cash from operating activities. Here's the net cash from investing activities. Here's the net cash from financing activities. We add or subtract those net changes to the beginning balance. That proves our ending cash balance, which is on the balance sheet. Okay, so we're going to have to recognize that we're proving our cash is really what we're doing. We're proving our cash balance. Now, we looked at investing and financing activities. There may be a time when we may have a non-cash investing and finance activities. Okay, it doesn't impact our cash, but it's important information that we need to get out there. Okay, so when we look at non-cash investing and financing activities, these are going to affect future cash flow. They're not going to impact us now, but later on down the road, that non-cash transaction that we have now, later on down the road, it will affect our cash. Okay, so what we need to do is if we have any non-cash transactions, we have to note them, right? Meaning we have to disclose them on a separate schedule. Okay, so what are some examples of non-cash investing and financing activities? Well, we issue stock or bonds for a long-term asset, right? Meaning we want to buy a long-term asset from somebody. We say, hey, how about we issue you a bond instead? They say, okay, sure, no problem. Or how about we'll give you stock for this? And the owner of this long-term asset says, okay, no problem, right? We could exchange long-term assets for other long-term assets, right? We might have a bond, and we might want to issue a new bond to repay that old bond. We could do that. That is an example of a non-cash transaction. But later down the road, when that second bond comes due and we have to start paying on that second bond, that's going to affect future cash flows. Okay? And then if we ever convert long-term debt into common stock, that's the third example of non-cash investing and financing activities. Okay? So when we go through this chapter, we're going to look at how we present cash flow information, and we're going to work to put one together. Now, GAAP, remember GAAP governs everything that we do. GAAP says, hey, there's two methods that you can use, the direct method or the indirect method. We are going to focus here on the indirect method, okay? Don't worry about the direct method. We're just going to focus on the indirect method. Now, what's the difference between direct and indirect? Well, I'm going to tell you right now, I think the indirect method is much more easier. And these two methods only apply to cash flow from the operating activities. Okay? So the investing activities and the financing activities, the way we calculate that cash flow, it's going to be the same under both methods. So keep that in mind. When we're looking at which method do we use, direct or indirect, it only applies to the operating section. We're only going to worry about the indirect method, not the direct method. Okay? So real quick, kind of a check your knowledge kind of a thing. Which of the following activities is considered an investing activity? Well, let's think about this. An investing activity, what are we buying, right? Well, investing says that we're looking at investments, long-term assets, PP&E. So purchase of merchandise for resale, that's not an investing activity, that's an operating activity, right? Because that's our operation says we buy merchandise and resell it, right? Payment on an existing bank loan, well, that's probably going to be operating activities, right? Purchase of a new warehouse, well, that's a PP&E, right? Payment of wages to employees, well, that's going to be another operating activity. So our answer here should be C. Okay. When we come back in our next video, we're going to spend a lot of time going through how we prepare the statement of cash flows using the indirect method. Now remember, this indirect method only applies to the operating section, okay? So please tune back in for that video, and we'll see how we prepare the statement of cash flows using the indirect method.